More and more Americans with government-backed mortgages are finding themselves falling behind on payments. A dark warning for consumer health. Let's dive into it. Hey guys, welcome to the channel. Frank Talks Money. Real quick, I just need one small favor. Remember to smash that like button. The more likes the video receives, the more the algorithm will show the video with more like-minded people like you and me. Now let's get right into the content, guys. Guys, right now, they say more and more Americans with government-backed loans are falling behind on their mortgages, which is a troubling sign for the future to come. Borrowers who got home loans through government-backed programs are increasingly falling behind on their payments, a potentially warning signal for how lower-income Americans are faring in today's economy. Delinquency rates on FHA loans and VA loans have reached 11% and 5% respectively at the end of the year for quarter number 4, 2024, according to the Mortgage Bankers Association. While FHA loans and VA loans don't have high income restrictions, they're insured by the government and have looser down payment and credit score requirements than conventional mortgages, making them popular among borrowers with deemed credit or lower incomes. And this is what gets people in trouble, guys. It all goes back to like the 2008 housing crisis, when people were taking out loans. Companies were giving people loans with 550 credit scores, 650 credit scores, 600 credit scores. And what happened? The housing market went belly up because all of these homes, all these individuals came to not be able to afford those homes. And they all had to walk away. They all got foreclosed on. And the real estate industry went belly up and was a very big much of a cause of the 2008 recession. You can't give people loans that can't afford the loan. You just can't do it. Hey guys, if you're still here, smash the like button for me, please. Guys, if you're still here, smash that like button for me, please. Conventional mortgage delinquencies are creeping up too, but at a much slower pace. While the Fed is cutting rates, and that's helped lift asset prices a little bit, those on the lower income household side are not feeling any benefits. Their borrowing costs are going down. If anything, they've been going up, and we still have a sticky inflation that's eating into spending power. January Consumer Price Index data show prices up 3% from a year earlier, well above the Federal Reserve's 2% goal. The Fed cut interest rates 3 times in 2024 amid signs that inflation was easing and the job market was weakening. But they are on a pause now as inflation shows signs of persistence. Traders are now expecting only 1 rate cut this year. So guys, basically people with FHA loans, VA loans, they bought homes that they could not afford. Even though there was a much easier way to acquire the home, lower down payment, lower credit scores. Now again, it's coming back to haunt these individuals, and it's coming back to haunt the government because these loans are backed by the government. The reasons consumers are falling behind on their mortgages vary. About a quarter of FHA borrowers who were serious delinquent, meaning they were more than 3 months behind on their payments, cited loss of income, followed by 20% who blamed excessive debt. There goes that word again. Debt, debt, debt. Guys, debt is killing people in 2025. Debt is killing consumers right now. Debt is killing Americans right now. If you have debt, high amounts of debt, you are going to struggle. There is no other way to say it, guys. Debt is killing individuals right now. But as Americans, that's all we know how to do is take on debt, debt, and more debt. Now it's time to come pay the piper. And guess what? Individuals do not have the money to pay the piper. Private mortgage lending, subprime borrowers all but dried up after the financial crisis. And FHA loans provided the closest way to buy a home today. Even in the best economic times, delinquency rates on these loans are typically several times higher than on conventional loans. Higher income consumers have fared well in recent years because they're more likely to have invested in the stock market and benefited from several strong years of gains, plus they spend a smaller portion of their incomes on essentials like groceries, and they stay away from debt. There you go. There you go, right there. Higher income consumers have fared well in recent years because they're more likely to have invested in the stock market and benefited from several years of gains. But here's the secret, guys. You don't have to be a high income earner to benefit from the stock market. But those that are benefiting from the stock market, guess what? They're not in trouble. They can pay their bills. They have money saved. They have access to cash. They're building wealth. They're staying away from debt. Individuals that are following that criteria do not have issues with money or paying their bills. See the irony there? See the irony there. I stay away from debt. I have some money saved. I invest in the stock market. I'm building wealth. And I don't have money issues. See the irony there, guys? Richard Bandino, chief economist for VantageScore, has been eyeing growing delinquencies among high-income group his credit scoring company tracks. Those earners who make over $150,000 a year are now falling behind on mortgage payments, car payments, and credit card debts at a relatively faster rate than households bringing in $50,000 annually. But what's hitting the high-income earners? The costs of these high-income earners are inflating because they are taking on more debt for things like credit card debt, car payments, insurance, and school tuition. So even high earners that are in debt, have no money, living paycheck to paycheck, they're in trouble, guys. So guys, I just want to pass this information on to you guys right now, how Americans, it always comes down to individuals with the lower credit scores. It's just how it is. This is what the statistics say, guys. Lower credit scores, those with hardly no money, those with that can't put a decent down payment down on their homes, those are the ones that's going to be losing their homes. It's almost just like going back to the financial crisis of 2008, because they were giving loans to individuals that were on the lower income side, lower credit side, not having a whole lot of money on that side, and guess what? Those individuals are defaulting on their loans. I mean, that's not what I'm saying. That's what the statistics are saying. So guys, I want to just pass that information on to you guys, why more Americans with government-backed loans are falling behind. And then you get into the higher income arena, they are falling behind. It's the ones that are falling behind is because overall, it seems like the ones that are falling behind on their mortgages are the ones with debt, no money, and not investing. Those are the ones that are falling behind on their mortgages. So guys, remember to like this video, share the video, and most important, please consider subscribing to my YouTube channel, Frank Talks Money. And with that, guys, always remember, financial decisions you make today will impact your financial life tomorrow. Thanks for tuning in. Frank Talks Money. I am out.